Hi, welcome to the level 3 session today. Thanks for joining. We're going to be looking at depreciation today. This is part of the financial accounting preparing financial statements unit, which is the second unit of level 3. So you might not all be at that point just yet, but we will be recording this video and sending it to you as well. So it will be a good tool to look back on at a later point if you're not quite at this topic yet. Okay, but we will be looking at depreciation today and the various stages from a beginning through to a middle and end point of view. Okay, because we are recording the video and we're going to be sending this out to everyone, could I just ask that we put our microphones on mute for now. We'll run through the activities covering the different points, and then we'll do a Q&A at the end. There is a Q&A box within the that you can click on, so just type any questions in there that you may have. We'll address those at the end. So let's make a start. Excellent. So, as we said, today we're going to be looking at depreciation. Okay, we've got 5 activities that we are going to look at today. The first 2 are going to involve looking at the different ways of calculating depreciation. Okay, the third is going to look at how we post that to the accounts. We're then going to look at disposals. Disposing of an asset at the end of its useful life, and then also looking at what a part exchange looks like as well. Just before we get into this, obviously, you know, what is depreciation? Okay, it's part of our year-end adjustments, which we have to complete, where we calculate the loss in value of our non-current assets over a period of time. Okay, it's part of the IAS 16 standards, so it's a requirement that we must complete at the end of the financial year. So first of all, we're going to look at one of our methods that we calculate depreciation. Okay, this is going to be the straight line method. Okay, so let's look at an activity here. A business has purchased a non-current asset for £22,000, which has a useful life of 4 years and a residual value at the end of this period of £9,000. Depreciation is calculated using the straight line method. What is the net book value of the asset after 2 years? Okay, so this is a typical question you might get asked in an exam, okay, where we have to look at using the straight line method to calculate depreciation. Some of the key points to note within this question are how much the asset cost when we first bought it, which in this case is £22,000, how long the business intends to keep the asset, and a residual value at the end of that period. Okay, so the residual value is how much we expect the asset to be worth after 4 years' time. So they're the key areas that we need to look at in this question. Okay, so the first thing that we need to do is look at the amount of depreciation which we need to calculate. Okay, now we have been given a residual value, okay, which means we're effectively starting at £22,000 and 4 years later we're going to be ending at £9,000. Okay, so the difference is the amount of depreciation that we need to apply. Okay, so we're going to start with £22,000, which is our at cost amount, minus the residual value, means that we have a total depreciation £13,000. Okay. Now, depreciation is charged each year, okay, and we're using the straight line method here. The straight line method means that we proportion our depreciation charge over an equal amount each year over the asset's life. Okay, so the charge each year is going to be exactly the same. So 13,000 total depreciation divided by 4 years, because that's the amount of time we expect the asset to be kept within the business, equals £3,250 per year. Okay, so that's our depreciation charge per year. Okay, just going back to the question, okay, so we've first been able to work out the charge per year. What we need to know is what the net book value of the asset is after 2 years. So effectively, what is the value, the current value of the asset within 2 years' time? Okay. We know that our depreciation charge per year is 3,250. Okay, so we need to apply 2 years worth of depreciation, which equals £6,500. Okay, that's 2 years depreciation. Okay, and to work out our net book value, we take our original cost of the asset, which is £22,000, and we deduct the depreciation which has been charged at that point in time, which we've worked out as 6,500, which means the net book value of the asset after 2 years is £15,500. Okay, that's the net book value. Okay, what we do is just take a look at when we're looking at these type of questions, it's all about picking out the key details. Okay, net book value means looking at what the asset is worth at any particular point in time, and it's always going to be the difference between how much we paid for the asset against how much depreciation has been charged against it. Okay, so that's how we work out depreciation using the straight line method. The second method that we're going to look at is what's called the diminishing balance, or it's sometimes called the reducing balance method. Okay, so where we looked at the straight line method and we applied this an equal charge of depreciation each year, the reducing balance method actually charges a percentage rate on the carrying amount per year. So let's have a look at what this looks like in this activity, and we'll highlight some of the key details. So we're using some of the information from the first activity so we can look at the comparison. So a business has purchased a non-current asset for £22,000, which has an estimated useful life of 4 years. Okay, so that information is the same. We paid £22,000 for the asset and we expect to have it for 4 years. However, depreciation is calculated using the diminishing balance method at a rate of 20% per year. Okay, What we need to do is calculate what the depreciation charge is for each year and the carrying amount at the end of each year. Using this method, the depreciation charge is going to be a different amount each year. And it will start higher in the earlier years and then gradually get lower within the later years. Okay, so let's have a look at how we calculate this. So firstly, we need to calculate our year one depreciation charge. Okay, we're told that depreciation is calculated at a rate of 20% per year. So we can start with our £22,000, which is what we paid for the asset. That's the original cost, and times by 20%. Okay, which should give us £4,400. Okay, this is going to be our first year depreciation charge. Okay, so we can enter that in our year one box. Okay, the carrying amount is then the difference between the at cost amount of 22,000 and the amount of depreciation we've charged. So 22,000 minus 4,400 equals 17,600. Okay, so we can enter that into our carrying amount box. Okay, so what we're saying is we bought whatever this non-current asset is, say a vehicle or a piece of machinery, okay, for 22,000, and after a year, when depreciation has been charged, we're actually estimating that it's now worth £17,600. Okay, so it's lost value over that first year. Now we're at year two, okay, and we're still using the same rate of 20% per year. However, the 20% is always applied to the carrying amount. Okay, so for the first year we had to use the at cost. This time for year two, we're going to use the carrying amount of 17,600, and we're going to times this by 20%. This will give us a depreciation charge of 3,520. So we can put that in our year two box there. Okay. Our carrying amount then becomes 17,600 minus the depreciation charge for that year, which should give us 14, let me just undo that, 14,080. Okay, so we can add that into our carrying amount box there. Okay, so after 2 years, the value of the asset has gone from 22,000 to £14,080. And we're going to repeat this process for each year. Okay, so again, we use the carrying amount, which is 14,080, times it by 20%, which will give us a depreciation charge of 2,816. So we can enter that in our year three box. And this will give us a carrying amount of 14,080 minus the charge of 2,816, which should be 11,264. Okay, so we can add that into our year three box. And then finally, for year four, we do exactly the same thing. So 11,264 times 20%, equals £2,252.80p. So we can enter that in our year 4 box. And then this will give us a carrying amount of 11,264 minus £2,252.80 equals £9,011.20. Okay. So a slightly different method there. Okay. Both methods are acceptable, but look out for questions that you're dealing with because you will be told what to use, either the straight line method or the reducing or diminishing balance method. Okay. Remember that when you're using the reducing balance method, you're always going off the carrying amount and applying the same percentage each year. What you'll notice is that the depreciation charge in the earlier years is higher because you're applying that 20% to a higher cost, and it gets gradually lower over time, as opposed to the straight line method, which we can see was a fixed amount of £3,250 per year. Okay. So they're the two methods there. It will be down to each business's own policy as to which method they apply to each specific asset within their business. Because the reducing balance method has a higher depreciation charge in the earlier years, it will be more suited to use on assets that lose value quicker when they're newer, and slowly that decreases over time. If you think of a vehicle, for example, which has 0 miles on the clock, the second you drive that car out of the garage and there's a mile on the clock, it loses a lot of value because it's no longer brand new. Okay, so there'd be a higher depreciation charge in the earlier year there. The same could apply with certain technology. Technology is always evolving, so it can quickly become out of date if newer models are released. But again, in any question that you get, you'll be given that information. Excellent. So on the third activity, we're now going to have a look at what this looks like in the accounts. Okay. So another example here, we've got a business which has just completed its first year trading, has machinery costing £120,000. The depreciation policy is to depreciate machinery at the rate of 20% using the straight line method. Show the ledger entries for the depreciation at the end of the first year. So there's going to be 3 accounts that we deal with during this process. Okay, we can already see that we've got a machinery at cost account, and on the 1st of January 2020, we bought that machine for £120,000. That's already in the accounts and has been there all year. However, we've just completed our first year trading, so now we need to record our first year depreciation. Again, picking out key information on there. Depreciation is at the rate of 20%, and we're using the straight line method, and we know that it cost us £120,000. So just before we calculate that, we're going to look at the 2 accounts that we'll be dealing with in addition to the machinery at cost account. The first account is what's called a depreciation charge account. Okay. And this is an expense account where we post our annual depreciation, okay, the amount that we charge each year. The second account that we're going to use is what's called an accumulated depreciation account. Okay, and it will be specific to the type of asset that you're dealing with. In this case, it's machinery. Okay, so this will be an accumulated depreciation account. Okay, so first of all, we need to record the annual depreciation charge. Okay, we know that we're using the straight line method and that the machine cost us £120,000. The rate is at 20%. So we're going to times that by 20% to give us an annual depreciation charge of £24,000. Okay, note that in this example, there isn't a residual value which has been given. Okay, sometimes there will and sometimes there won't. If there is, you just need to remember to look at the difference, just like we did in activity 1, to calculate that total amount of depreciation. If not, you can just apply the percentage rate to the at cost amount. So we've calculated that the annual charge is £24,000, and we're going to debit that to our depreciation charge account. Okay, so that's £24,000 on the debit side because it's an expense account. Okay, and we're going to use the date 31st December because this is part of our year-end adjustment. Now, the opposite entry is going to be posted to our accumulated depreciation account. Okay, and this will be posted on the credit side. So 31st of December will be for the same amount of 24,000, and that will come from the depreciation charge account. Okay, so we record the annual expense within the depreciation charge account, and then we record the accumulated depreciation on the credit side within the accumulated depreciation charge account. And what that looks like in the accounts, and it's how we work out our net value of any current assets, is our depreciation account appears in the statement of profit or loss because it's an expense account. The machinery at cost account appears in the statement of financial position, and the accumulated depreciation account also appears in the statement of financial position. The asset at cost account will have a debit balance, and the accumulated depreciation account will have a credit balance. So the idea is that the accumulated depreciation account will offset against the asset at cost account, which will show a net value of the asset at that particular time. Okay, so what that looks like within the accounts is that we've got the machinery at cost is worth £120,000 when we bought it. We've charged £24,000 in depreciation, which means the difference will be £96,000, and that is the net value of the asset. Okay, and that's the purpose of having this account. It will offset against the asset at cost account. Okay. Now, this is also part of our year-end adjustment. Okay, so one other thing that we're going to have to do, because this is at the end of the year, is we need to transfer the amount within our depreciation charge account to the statement of profit or loss. Okay, so we'll do that on the same date because it's the last day of the year. That's going to our statement of profit or loss, and it will be for the amount of 24,000. Okay, so our depreciation charge account has now been cleared, and that's recorded within the SPL. Because our accumulated depreciation account appears in our statement of financial position, instead what we do is balance off the account, so we have a balance there ready for the next financial year. So we can add the 31st of December, balance carried down of 24,000. Okay, which then on the 1st of Jan becomes our balance brought down of 24,000. Okay, so we're starting the year with that accumulated depreciation. What we will then do for every year that the asset remains in the business is repeat this process. Okay, at the end of the following year, we'd do exactly the same. We'd charge the amount of depreciation for that year, and then we'd post that annual charge to the accumulated depreciation account. Okay, that accumulated depreciation account, because you're adding a balance brought down each year, will begin to stack up. Okay, so at the end of year 2, there will be £48,000 depreciation in there. At the end of year 3, there'll be 72,000 within there. Okay, that carries over multiple years because it will always offset against the original amount that the asset was bought for. So it will always show a net value of the asset. Excellent. So we've looked at calculating depreciation, and we've looked at posting that within the accounts, okay, and how we'd repeat that each year. The next thing that we need to look at is what happens when we dispose of an account. Okay, what happens when that asset is no longer within the business, okay, and it needs removing from the accounts. Okay, so I've already populated the accumulated depreciation account, so you can see how that looks over a period of 3 years. So after 3 years, at the end of the financial year, the machinery in the previous question, so we're following on from the previous activity, has been sold for £40,000. What we need to do is show the ledger entries for this disposal and whether there is a profit or a loss. Okay, so the 3 accounts that we're going to be dealing with in the main part here are the asset at cost account, so in this case the machinery at cost. We're going to be dealing with the accumulated depreciation account, and then we're going to be dealing with the disposals account. Okay, now the disposals account is used for when we need to, when an asset's been sold or when it's no longer part of the business, we need to remove that from the accounts. So the first thing we're going to do is exactly that. We're going to credit the machinery at cost account. Okay, so 31st of December, and it will be the year 2022 there because we're 3 years on from when we originally bought it. Okay, for 120,000. Okay, and that's going to the disposals account. Okay, so we can record that on the debit side of our disposals account. Okay, so it's for the amount of 120,000. So the 31st of December 22, and that's come from our machinery at cost account. So our machinery at cost account has now been cleared following the disposal of the asset. We also have to clear all of the depreciation which has been accounted for that particular asset. So we can see year on year, looking in the accumulated depreciation account, that depreciation has been charged of £24,000 each year. Okay, so 24,000 has been charged each year. Okay, we already have our depreciation calculated for this year, so we're just dealing with the disposal here. Now, typically, we'd enter in a balance carried down and this process would continue. However, we're dealing with a disposal, so we need to clear this account. Okay, so we're going to do exactly that. On the debit side, on the 31st of December 22, we're going to debit for 72,000, which is the balance brought down of 48,000 plus the depreciation charge for that year to the disposals account. Okay. And that will go on the credit side of the disposals account, the 72,000. Okay. That's from our accumulated depreciation. So that's the first two steps: remove the asset from the cost account and remove the depreciation. There's one more entry that we need to add into the disposals account before we're able to identify whether we've made a profit or loss. Okay, and what we've been told in the question is that the machinery has been sold for £40,000. Okay. Now, the bank would have been debited 40,000 for the amount received. So we're going to credit the disposals account for that 40,000. Okay. So the bank's been debited for the income on that, and we're going to credit the disposals account. Okay, this means we're now allowed to calculate our profit or loss based on the disposal of this asset. So it works in the same way that we calculate a balance carried down. Okay, the profit or loss is posted on the lesser side, debit or credit side of the disposals, okay, for the difference between the two columns. The debit side is equal to 120,000. The credit side is equal to 112,000. So the SPL entry for 8,000 will sit on the credit side. Okay. That also sits there as well. So that goes to the SPL. And this means we've made a loss on this disposal. So if the difference sits on the credit side of the disposals account, it means you've made a loss. If the difference falls onto the debit side of the disposals account, it means that you've made a profit. Okay. The idea is, and it's depreciation is always an estimation, but the idea is to get as close to zero as possible. Okay, it's very difficult to do, and businesses will only be able to review, their policies and adapt to try and get as close to that as possible. But there will always be a loss or a gain. The idea is it for not to be too significant. Okay. If we've sold this asset for 40,000, but we've still made a loss, okay, we can assume that that 40,000 is how much it was valued at the time. What that actually means is, although we've made a loss, okay, we actually haven't charged ourselves enough depreciation each year, okay, which would have affected our previous year's profit or loss figure. And it works the same the other way around. If we make a profit on a disposal, it means that we've overcharged ourselves depreciation in the previous years. So it's not all about, you know, oh, we made a profit on this disposal, that's brilliant, because actually you've given yourself a little bit more of a loss in the previous years. That's why it's important to try and be as close to zero as possible without too much of a significant effect. Okay. Now, the only other thing that we need to look at in this final activity is what happens when we're dealing with a part exchange. Okay, so we're following on from the previous example. Okay, so using the above information, what would be the difference in the double entry if the machine had been part exchanged for a new machine costing £140,000? Okay, so we still follow the same process at first. Okay, we still need to clear the machinery at cost account, and we still need to clear the depreciation to the disposals account. Okay, so we'll follow the same process. 31st of December 22, we'll clear the asset at cost account. Okay, and that will go to our disposals. So again, 120,000 on the debit side of the disposals there. From the machinery at cost account. Okay. And just as we did in the previous example, we're going to debit the accumulated depreciation account, 72,000. We're going to credit the disposals account, 72,000 as well. Okay. And that's our accumulated depreciation. So that part is exactly the same. Now, the difference is, in the first question, okay, we were told that the vehicle had been sold for £40,000, which means this entry in the disposals account on the credit side, okay, so this entry, this entry here, okay, we debited the bank account and we credited the disposals account for 40,000. However, we've not actually received any income for the asset because we've part exchanged it. So instead of debiting the bank account for 40,000, what we actually need to do is debit the machinery at cost account for 40,000. Okay, so we still credit the disposals account 40,000 here. Okay, because that's what the asset is worth. Okay, but it's going to our machinery at cost account. Okay, instead of the bank account. Okay. And this is what's called our part exchange allowance. Okay, it's our part exchange. Okay, so we haven't actually received 40,000, so we can't debit that to the bank account, but actually it's gone towards the cost of the new machine. Okay. So this new machine costing 140,000. Okay. What we then need to do is record the new machine within the machinery at cost account. Okay. So what we have done here is we have paid £100,000 for the new machine. Okay, so we can debit that in the asset at cost account and we'd credit the bank £100,000. Okay, bearing in mind that this new machine costing £140,000 is made up of 40,000 from the disposal plus £100,000 payment for the difference. Okay. We'll notice that in the disposals account as well, when calculating the profit or loss, that this still sits at £8,000 on the credit side, okay, for the difference, okay. So the examples are the same and the valuation of the machinery is the same. So we've still made that loss of £8,000 on the old asset. The only difference in the disposals account is that instead of doing the entry to the bank, we do it to the machinery at cost account. And just to finalize what's in our machinery at cost account, okay, so we'll balance off the account. So the balance carried down needs to be added onto the lesser side. Okay, we've got 260,000 on the debit side. So the original 120,000 plus 40,000 plus 100,000. And then we've got 120,000 on the credit side. So the balance carried down will be for the difference, which is £140,000, which on the 1st of Jan 23 becomes our balance brought down of £140,000. And when we start in the new year, that matches to exactly what the new machine costs. Okay, the old machine's been disposed and we've now got a new machine worth £140,000 sitting in the asset at cost account, ready for the new financial year. So that's the difference between looking at a disposal and including a part exchange in there as well. Okay. Instead of the credit entry to the bank, instead we post the credit entry to the asset at cost account. Okay. But just remember, with it being a part exchange, that only forms part of the new asset's value. So we also have to include the amount paid, which is the difference between the value of the new machine and the part exchange allowance. Okay, and that covers everything within this session. Okay, so just a quick recap. We looked at the two valuation methods first. Okay, sorry, the two calculation methods first. Okay, which was the straight line method in activity 1, the reducing balance in activity 2. In activity 3, we looked at how we record that first year's depreciation by calculating the annual depreciation charge and posting that within the depreciation charge account and the accumulated depreciation account. The disposals is when we're approaching that end of life of the asset and we're removing that from the business accounts and how we have to introduce the disposals account to account for that. And we can either sell that asset, we can scrap that asset, or part exchange it, which is what's covered in activity 5. Okay, does anybody have any questions on anything that we've covered today? Feel free to pop anything within the Q&A box, which is just on, which you'll just be able to access there. Pop any questions in there if you want to have a look at those. If you don't want to ask any questions publicly, that's absolutely fine. Do feel free to drop an email after this, just to the usual AAT3 email address. More than happy to come back separately on an individual basis if you'd feel a little bit more comfortable with that. All good, thank you, Kat. Excellent. Okay, any other questions? No. Okay, thank you very much for dialing in today. Really appreciate it. Like I say, any other questions or any feedback, please do follow up. And yeah, I'll be happy to go through anything with you. Perfect. Thank you very much, everyone. Take care.